Everybody, welcome. And this is version 2 of our webinar, and I appreciate everybody coming back on this gorgeous June day. I'm going to get to introduce David and Claire in a moment, but again, I am Kieltyka, CEO of the YMCA, and we were just chatting. It's an exciting time for us. On the heels of the governor announcing that the stay-at-home order has been lifted, we are finally opening on Monday part of our programs, and that's 3 months to the day that we have been closed. It's been a long 90 days for all of us. I think we can agree. And on Monday, June 15th, we will open our child care center, the Learning Center here in Summit. And then on July 6th, we will launch all of our day camps, our summer day camps, which we're very excited about. We also expect at the same time that weekend, July 4th weekend, to open a brand new Berkeley Heights outdoor pool. And so that too has gotten approval from the state to open outdoor pools. So we're very excited about that. And we know that when we look outside at 90-degree weather, we are ready for outdoor pools. And then we are hoping, fingers crossed, that shortly thereafter, we can get our buildings open. But we do have outdoor classes starting up soon. The response from you and the community has been tremendous for those. So we want to get you outside and get you exercising and getting you together. But the last thing I say on all of this is our #1 priority is safety. So we're working very closely with the local Board of Health, the state, regional, federal agencies like CDC to make sure your kids, you as members, are completely safe. And obviously that is paramount to us at all times, but to keep our staff and our members safe is obviously the most important thing. So let me bring you back to today. And our work here as a nonprofit has certainly been challenging. As I said, we have been closed for 90 days, for 3 months, and we took the decision on the behalf of my board and I to hold everybody's membership. And obviously with no childcare, with no camp, with no sports programs, we have not collected any fees from anybody. Now, a large number of you have very generously donated your membership fees at our request, and we are forever grateful for that. So during this shutdown period, your membership fees have been donations. And I know Claire and David are going to talk about that in a little bit. However, the importance of you supporting us as a nonprofit is as strong as ever. Nonprofits like ours and so many in Summit have really been hit hard. There's been very little federal help during the CARES Act. There's PPP loans and things of that nature. But overall, we have not received any direct funding to help our bottom line on the revenue side. And the staff that works here, the team has been tremendous, but we still need your support. I cannot say that enough. We need your support in a big way to help us get through everything. So without further ado, I definitely would like to bring on David and Claire. And just a quick introduction. David Dietze and Claire Toth have been not only incredible pillars of the community, and supporting the civic leaders, put it that way, and legends in my opinion, but nonetheless, they are 2 people who care very much about the health and well-being of our community. And that includes your financial health. And their business is not really a business that you would look at many others. It's one about taking care of you personally. And today's discussion is very important to what I just ended up on, and Claire and David have tremendous expertise in helping us understand how we can maximize our personal assets, whatever they may be, to most efficiently help nonprofits and other groups in the community like the YMCA, continue to do their good work and continue to do their mission. So without further ado, Claire and David, and again, I thank you so much for sticking with us here today.
Hey, thank you so much, Paul. And, I've been a Y member for over 25 years. And my wife, Claire, who's going to be our fellow speaker, has been there at the same time. And, you know, there's nothing better than an opportunity to kind of share your expertise on behalf of an institution that you care so much about. And I so miss getting over there at early in the morning for the workout, and can't wait for them to open up. But you know what makes me feel really good about going to work out and participate to Y? Obviously, there's always a lot of different places where you can go and burn some calories. What I really like about the Y is, in addition to a first-class health care facility, they give back so much to the community. And there's so many different programs, whether it's the child care program, whether it's making sure that anyone in the community, without regard to ability to pay, has a home there, can go in there and work out, can join the various groups, can attend the camps. I think that's so important. So it's really win, win, win all around. And so we're going to get into some technical aspects of how you can get the most bang for your charitable buck. But I do urge you to definitely keep the Y in mind when you're when you're doing your charitable giving. And I have to tell you that nonprofits have been hit hard, gyms have been hit hard. The YMCA is right at that crosshairs thing, and so no one needs it more. And there's no institution that's more important for us to help get back on its feet and be as strong as they're going to try and make us once we get back working out. So thank you, Paul. So let's get into the meat of our presentation here. I'm going to try and share my screen here. And you know, the title here, of course, is Helping Your Charitable Dollars Go Further. And to be perfectly honest with you, the real star of today's program is Claire Toth. You can see her picture here. She's the tax attorney with over 30 years expertise, including 12 in the belly of the beast. That would be the IRS. She'll call it the Treasury Department, but we know what it's all about back down there in Washington, D.C., plus has spent many years in private practice. We are so lucky to have her head up our financial planning division. You're going to hear from her in a moment. Before we get to that, people say, well, who the heck is Point View? And let me see here. And Paul was kind enough to talk a little bit about it, but basically we want to be for families what the Y is for your health. We want to be like the CFO for families, be the first call for anything financially related. What does that include? That includes managing their portfolios. That includes advising them on minimizing their taxes, making gifts to charitable institutions, passing money along to the next generation, estate planning, you name it. If it has to do with finances, we want to be the primary contact for our clients. We are part of PPAC Private, which is a local bank that does happen to have $7 billion under management out in Gladstone, New Jersey. We work with clients at $500,000 and up. It's a 1% fee. All of our clients' assets are custodied at Fidelity Investments. We're not directly touching them. They're at a world-class financial institution in accounts under the client's names. We also offer a financial planning package if they should not, if a potential client should not want their money managed as well. We are very lucky to have a talented group of individuals that work with us as a team to work with our clients. We've got 4 portfolio managers, Elaine Phipps, Donna St. Amant, Fritz Schoenhut, yours truly, and then we have some great client service people, Marcella, Chris Gilmartin, Jeanette Carey, and Annette Tucker. There we are in the first floor of the Bassett building. That's right opposite Peppercorn in beautiful downtown Summit. Come down and visit us. Well, when it's permitted to come down and visit us, we'd love to see you here at our office. We've been very fortunate to be recognized over the years for our outstanding service by CNBC, Investopedia, Financial Advisor Magazine. We are very proud of that. Congress, in its wisdom, has made some changes to the laws that they have now relaxed a little bit so that we can be more generous to our favorite charitable institutions. If we go back a couple years, Congress gave us something and they took something away. What did they give us? They gave us a very large standard deduction, which is actually $12,400 for singles and almost $25,000 for a joint filing. What's that mean? It means that most people, in fact, over 90% of the people, do not have to itemize, in fact, cannot itemize their otherwise deductible expenditures because the tally of those don't get up in the case of the individual, $12,400, in the case of a husband and wife, $25,000. What made it even more difficult is the so-called SALT. What was the SALT? The SALT was the cap on the amount of state and local taxes that you paid that could be deducted. That was capped at 10. So if you're a husband and wife, you're capped at 10 for that. You got the 25 standard deductions. Most people are not able to give enough in terms of charitable deductions to get past that 25 when they can only deduct 10. So what Congress did do is said this year, no matter whether you're deducting or not, if you give $300 or as a couple, $600, you can write that off, no matter whether you're allowed to itemize or not. So there's no reason for anyone to say, gee, I can't get a tax benefit. We always say that's not the primary reason to give, but everyone will get a tax benefit for giving as a couple $600 to their favorite charity. It must be a cash gift. And of course, a lot of people were big advocates of using charitable foundations, where basically you give the money to a investment group, for example, Vanguard or Fidelity or something like that, is invested, and then you can give the money from there. You get the immediate deduction, and then later on you can dole it out to your favorite charities. Your $300 can't go to one of those and still qualify for this immediate $300 deduction. So there's another way that Congress made it a little bit more generous for those who are giving to charity this year. Now, it used to be that you could only take a deduction for up to 60% of your income for a charitable gift. So for example, if you made $50,000, you could only give $30,000 and get the deduction that year as a charitable gift. Now, if you make 50, you can give up to 50. So that's been changed. Again, it can't go to one of those private foundations. The one thing to keep in mind is we are a big advocate of giving also appreciated stock. There is a cap in terms of giving appreciated stocks. If you make 50, you can only give 20 of appreciated stock. Excuse me, 15,000 of appreciated stock and still get a deduction that year. Anything that exceeded that, you could carry it forward. So what's one answer as to how to maximize your charitable deduction? If you're going to be capped by those limits in terms of amount of income you can give away, if you accelerate income into the year you want to make that charitable deduction, that would allow you to do that. Let me see. I'm going to give Claire a chance to take over on the next slide here.
Thank you, David. And I want to welcome everybody and also plug the Y. Not only have David and I been active members for 25 years, but our children grew up in the Learning Circle. They participated in programs all the way through, and it's been a huge benefit for them. So the Y is really there for the whole family. And I'm going to talk about ways to give that are a little more timeless. David was focused on additional charitable giving benefits just for 2020. So let's look at a couple that is 72 or above. These are folks who are required to take distributions from IRAs every year. Big footnote, this requirement has been waived for 2020, so that this will apply in years going forward. As David mentioned, we've got a much larger standard deduction. Seniors, in fact, get a larger standard deduction than younger folks. The standard deduction for seniors is $14,050 for an individual, or $27,400 for a couple. Most seniors don't have mortgages. There's no mortgage interest deduction. And again, they can only deduct $10,000 in state income and property taxes. So that means that a senior couple likely would have to make charitable gifts of over $17,000 in order to start deducting the first penny of it. But there's an alternative. So there's some math involved here, and I want to, I laid it out in these charts. So we've got John and Mary, who are married to each other. They're at least 72 years old, so they're required to take IRA distributions. They've got $200,000 in gross income. That includes their Social Security. It also includes the required minimum distributions from IRAs. And those required minimum distributions are at least $15,000. It really doesn't matter what they are above $15,000. So they're getting the $10,000 of state and local tax deductions, and they give $15,000 a year to charity. So that's $25,000 in potential tax deductions. However, as I said earlier, the standard deduction is $27,400. So despite the $15,000 they're giving to charity, there is no tax benefit compared to making 0 charitable gifts. And they're paying almost $30,000 a year in federal taxes as a result of all of this. Next slide, David. There is a special rule for IRA distributions that instead of taking it yourself and paying ordinary income, you can direct as much as $100,000 a year go directly to, again, an operating charity, such as the Y. So if John and Mary, instead of making $15,000 of charitable deductions from their checking account or wherever they're making it, they direct that $15,000 come directly out of their IRA and go straight to charity. That $15,000 doesn't even show up on their tax return. So instead of having $200,000 worth of gross income, they've only got $185,000. That's their top line. They get the same standard deduction of $27,400. They've got less taxable income. They've saved more than $3,300 in federal taxes. They've reduced their tax bracket. John and Mary have more after-tax dollars. The charity has the same dollars, and the only loser here is Uncle Sam. And I think at this point, it's back to you, David, for some other ways to make charitable gifts if you're not required to take IRA distributions.
Absolutely. So
I apologize. These are David gets to do the fine print around these rules.
yeah, so here's the thing on the distributions from the IRA. It cannot go to a donor advised fund. It cannot go to your Fidelity donor advised fund, Vanguard donor advised fund. It must go directly to an operating charity. So that's one thing to keep in mind. Another thing is that recent changes in the law now allow you to not have to take your MRDs out, your minimum required distributions, until you're 72. But you can still make the distribution from your IRA to a charity as early as 70.5. Now, why might you do that even though you're not required to make the distribution? Because at some point, every dollar under normal circumstances that comes out of that IRA is going to get taxed, either to you or if it's handed down to the next generation, they're going to get taxed. But if you send some of it out to the charity, whatever you send out to the charity will not be taxed whatsoever. A little footnote on that, New Jersey has no such thing. Some of our local politicians are trying to change that, but right now New Jersey has no such thing as a charitable deduction against New Jersey state income taxes. So whatever comes out, the state's federal tax under this program still is going to be taxed by New Jersey, but of course New Jersey rates are much, much smaller. Again, must go to an operating charity, not to a donor advised fund or a private foundation. And with that, I am going to go to the next slide here. So bottom line, as Claire described, is that by making that charitable contribution from your IRA, you're going to reduce your taxes by over $3,300 and have dropped down into a lower bracket. The Y gets the same amount of money. Who loses? Again, it's the federal government because you're saving taxes. Unfortunately, New Jersey is still going to get their cut. There's nothing that can be done about that. And now I'm going to flip it back to Claire.
Okay. I need a little bit of introduction here. David had alluded to what's called a donor advised fund. This is a way to get a charitable deduction now and make the gifts to charity down the road as you see fit. And there are a lot of times where it can be very useful. We'll go into one of them, but as David said, every brokerage firm in the world has one of these. A lot of community foundations do as well. A taxpayer can put in, say, highly appreciated stock and get a tax deduction today for the full fair market value of the stock, never having to take into income the buildup in gain since the stock was originally purchased back in the day. This is a great deal. Then the donor can choose when the money goes out to charity. Charitable donors who are not yet required to take IRA distributions can use donor advised funds to increase their charitable giving bang for the buck. So let's go back to John and Mary, who are now less than 70, so they're not making charitable gifts from their IRA. They have the same $200,000 of gross income. They've got the same $10,000 deduction for state and local taxes. This time, because they're younger, they've got a mortgage, and we're going to give them $10,000 of mortgage interest deduction, and they make a $5,000 annual gift to charity. That's $25,000 worth of potentially deductible expenses. Next slide, David.
Oops.
As I had, and so this is what happens. And here's the math with the $25,000 of deductible expenses. They've got a tax bill of a little over $30,000 a year. And so if everything is frozen at this level and we do it for 5 years in a row, you've got almost $151,000 in taxes. Do want to point out, John and Mary have $25,000 of potentially deductible expenses. The standard deduction is $24,800. So of their $5,000 charitable donation, really only $200 is being used to decrease their tax bill above the standard deduction. I hope I didn't lose anyone there. Next, David. Okay, so let's say John and Mary set up a donor advised fund, and instead of giving $5,000 a year to charity, they're going to they're going to put $25,000 in their donor advised fund this year, and use that to make the next 5 years worth of charitable gifts. And after this year, they're going to take the standard deduction of $24,800. Now let's compare the math. So the column on the numbers on the left are what we saw before, the $25,000 deduction. No, I take that back. The column on the left is for 2020. So we're increasing our charitable deduction from $5,000 to $25,000, reducing the tax bill proportionately. And for the following 4 years, we're taking the standard deduction and paying just a little bit more in tax than they would have had they made the $5,000 gift to charity for each of those years. But over the course of 5 years, they're saving over $4,200 in taxes, and that savings is really front-loaded into 2020. So again, John and Mary get the same after-tax dollars, charity gets the same dollars, the loser is Uncle Sam.
So back to me. I think everyone out there, if there's one takeaway that you walk away from this presentation with is, as you're getting ready to do good and helping out your local charity, think carefully as to how to do it, because in almost every circumstances other than $300 this year alone, it makes more sense to give stock or mutual funds from your portfolio, or tap into your IRA if you're 70 and older. And that even works for is a contribution as little as $50. And the way that works most successfully is, as Claire was describing, is to use a donor advised fund, which is kind of like a holding tank, an intermediary, where you can take your appreciated mutual fund, take your appreciated stock, put it in there, and then it's like you get that immediate tax deduction. And then it's a little bit like a bill pay, so that when the spirit moves you, which should be very often, you can, in your pajamas in the morning or evening, just type in Summit Area YMCA or whatever is your favorite charity, but hopefully includes the Y, and you can make distributions to the Y. Their address pops right up for as little as $50. So you can take the big fat share of Tesla at $1,000 and fractionalize it and create $20, $50 gifts out of that. And so if you were lucky or smart enough to buy that Tesla at 100, now it's 1,000, you put that $1,000 share in there, you bypass that $900 of unrealized appreciation, and you're able to then fractionalize it and send it out, and it doesn't cost you anything. And as Claire was alluding to, one way to get above that very now generous standard deduction of $24,800 for a couple is, if you're going to do 50 over the next 10 years, put it all in 1 year. Anything in excess of that standard deduction, you will get the deduction now, and then you can parcel it out over a timetable that makes sense to you. These donor advised funds are really available at any broker. You get that deduction on the way in, distribute it to your favorite charities over time. You don't get a second deduction. You only get a deduction for that initial gift. And that's what we recommend. Back to Claire.
Okay. We've talked about taxes. The other inevitability is death. And I get a lot of questions about estate planning. One thing I've been saying for a number of years when I talk about estate planning is it's not about the estate tax anymore. It's about the income tax. New Jersey no longer has an estate tax. We don't have to worry about that here. The federal government, the feds, continue to have an estate tax. However, there is an amount that can pass tax-free for a single individual. That's $11,580,000. For a married couple, that's $23,160,000. So if you do have a federal estate tax issue, I'd really like to talk to you. But for the vast, vast majority of people, we don't have to worry about that. When you and your spouse pass away, the money moves down to the next generation. Assets outside of retirement accounts get what's called a basis step up. There's whatever the value is on the date of death is the new cost basis, so that if your kids don't want to keep the house, if they don't like your stock portfolio, they can sell everything with no tax gain. This is not the case with IRAs and other retirement accounts. Whatever those dollars come out to you during your lifetime as ordinary income. The same goes for your children and your grandchildren. Now, in the good old days, which means prior to this year, if you left an IRA to your child or grandchild, that new beneficiary would have to start taking money out the year after you pass away, and would have to take it out over his or her life expectancy as mandated on certain government tables. And the idea was, you know, the money is for your retirement, it's not for your kids' retirement. The kids should start taking it out. And, you know, if you left it to your 50-year-old child, that child would be taking money out over 34 years. If you left it to your 5-year-old grandchild, your grandchild would take the money out over 78 years. And the tax policy wonks in their wisdom said, wait, you know, there is no good reason why beneficiaries should have an entire lifetime to take this money out. Let's shorten it. By the way, that's going to increase tax collections. So beginning with folks who pass away this year, if you leave your IRA to somebody other than your spouse, that person has to take everything out within 10 years of your death. And if you've got, you know, a 7-figure IRA, that essentially means that your children are going to get a 10-year fire hose of ordinary income that's then going to stop. And that may or may not be the best thing for your kids. On the other hand, if you leave that money to charity, the charities, as we've said, pay no income tax. So if you've got any sort of charitable giving in mind for as part of your estate planning, you should be naming charities as your IRA beneficiaries once you and your spouse have passed away. And what I've got up on the board, or up the slide up here, shows the difference, and this is all for somebody who is age 72 with the $1 million IRA. If that person is taking his or her first required minimum distribution, it's $39,000. If that person inherited an IRA last year, the first year's distribution is somewhat higher at $64,000. There are really tax geeky reasons for that difference. But beginning this year with a $10,000 payout, if you're going to do it ratably over 10 years, that distribution increases to $100,000. And the tax bill increases along with all of that. So we go to the next slide. Okay. So again, here are the new rules, and these rules, the 10-year distribution applies to inherited IRAs. If you leave your IRA to your spouse, that's not an inherited IRA. It's got its own definition. You went a little too far, David. Can we go back? Thank you. There are a few exceptions to this 10-year distribution rule. If your beneficiary is less than 10 years younger than you, for instance, you leave it to a younger sibling, that younger sibling pretty much has the same life expectancy you do, and gets to take over his or her individual life expectancy. If you leave your IRA to your grandchild who's under the age of 18, that grandchild doesn't have to start taking distributions until age 18, then has to take everything out before age 28 or by age 28. And as the owner of young adult children, I think that's a really bad idea, but we can talk about it. If your beneficiary is chronically ill or disabled, think of, the disabled adult child, there are some planning opportunities around that one. And if you've inherited an IRA, from your parent, and then you pass away, I have an IRA from my mom. It's a small IRA. If I were to get hit by the bus tomorrow, then David would have to take out what's left over the next 10 years, because that clock starts running for that IRA as well. And I think that's pretty much it. We do have some questions.
Yeah, absolutely. So there's a Q&A tab on the perimeter of your screen. If you've got a question, we've already got some good ones, but if you've got some questions, just type them in. We do have some time to address them. And of course, I will be the interrogator and Claire, the expert, will handle them. We had a good question as to whether there is a limit or percentage of giving requirement on an annual basis out of your donor advised fund.
There is not. And we can go into a bunch of rules. You can give as little or as much as you want each year from donor advised funds. There has been some concern about this because a lot of donor advised funds have just been sitting out there for a while and have not been active. That's not their purpose. And if you have a donor advised fund, please use it, because you don't want Congress to tell you what you should be doing with it.
Good, good. Hey, so although there's not a limit on how much you can cause your donor advised fund to distribute on your behalf, there is a limit on how much you can have your IRA distribute to a charity on a per year basis, right?
Right, that's $100,000 a year. And again, for a married couple, that's effectively $200,000.
Yeah, but from their respective IRAs.
That's correct.
Yeah. Hey, so some people inherit an IRA from an ancestor, perhaps a father or a mother. Can the distributions to charities work from an inherited IRA?
I believe they can, but you have to be 70 and a half.
Okay, okay.
And by the time you're 70, at that age, chances are there's a lot more in your own IRA.
Right, right, right. So some people have Roth IRAs.
Mm-hmm.
What about making a charitable distribution from a Roth IRA?
It's possible, but probably not your best choice of vehicle. Let's step back. A Roth IRA is a special creature. When you there are limits around who can put money in and how much. But when you put it in, you do not get a tax deduction. The dollars that are in there have already been taxed. And if it's used for approved purposes, retirement being one of them, or the primary one, then not only are the original dollars tax-free, but all of the appreciation is tax-free. So when you take the money out, there is no tax consequence. So using non-taxable dollars to make a charitable gift, it's a lovely, lovely thing to do. It doesn't benefit your bottom line on the tax return. There are probably better ways to make the gift.
Claire, is a gift from an estate inheritance taxable? For example, if it's specified in the will that the gift shall go to XYZ charity.
You mean if in my will I say I leave $25,000 to the Y?
Correct.
That's not taxable to the Y. It is in fact, if there were an estate tax, it would be a deduction from the estate. It would be deductible for the estate tax purposes.
And the only wrinkle is if you're giving to the next generation some money via will and some money via an IRA, you're better off causing the gift to the charity to come from that IRA, because everything that the beneficiary takes out of that IRA will then be taxed from an income tax point of view to them, unlike things that they're getting pursuant to the will.
Absolutely.
Okay.
And not only is what human beings get out of an inherited IRA taxable, It's taxable as ordinary income, which is the highest, the sorts of income that's taxed at the highest rate.
Yeah, unlike capital gains from
Mhm.
a profit on a stock or something held at least
Right.
12 months. So Claire, some people have, an antique car in their garage that they paid very little for. Now it's worth a whole lot more. Or maybe they have a valuable piece of art on the wall. Is that type of appreciated property eligible to be given to a charity? How would that work?
It is eligible to be given to a charity. There are some very technical rules around gifts to the charity that are lined up with its charitable purpose versus gifts that are not. This is once you're outside of the world of securities. If you were to give a piece of art to an art museum, that's part of the art museum's purpose and being. It fits right in there. You get the maximum deduction for that. If you were to give that piece of antique art, to the Y, which was going to turn around and sell it at auction for cash, then there are some limits on how much you're able to deduct. So that's the kind of thing where you really want some advice and to talk this through. I will note that most donor-advised funds out there, or many of them, are able to work with assets other than publicly traded securities. Real estate, privately held stock. I haven't looked too hard at stuff like art and cars. So if you've got something that isn't appreciated stock, you might want to look for a donor-advised fund that can accept that and help you help you maximize your deduction. Of course, if it's something with a great deal of meaning to you, you'd want to give it to a charity that lined up with that sort of asset so that the charity would use it in its mission.
Good. So I think we have time for one more question, Claire. And this is, I guess, donor's remorse. Let's suppose they take their Tesla stock and put it in their Fidelity donor advised fund, and it's sitting there and they're cogitating about which charity to give it to. All of a sudden, for example, there's a financial reversal. They want to get the Tesla stock back out, or the value of it. Can they?
The short answer is no. It is the donor is the advisor on that account, but the donor no longer owns the account. A donor advised fund is in fact a part of a charity. So you get your charitable deduction when you make the gift in, and it's no longer in your control. In fact, most donor advised funds will sell that Tesla stock right away and put it in a fund of some sort. Not all, but if you're not so sure you want to give away all of it, there are other more complicated charitable giving vehicles that involve trusts and lawyers and accountants and tax returns. Those tend to be more practical if you're talking at least a 7-figure gift. But for most of us, if we're going to make a charitable gift, we better mean it, because we're not getting it back.
Good. So all of you out there, I want to thank you for spending some time with us. Obviously, if you've got any questions that Point View, myself, Claire, or anyone on the team could help you with, we're always available for you. I know that the Y would love to hear from you. I have had interactions with their new development officer, Karen DeMaria, who seems like a real winner, and I'm sure that topics along these lines could also be fielded by her. This slide deck is available to you. If you just let us know that you'd like a copy, we can get that to you, and we wish you a very good afternoon.
And we'll see you in spin class soon.
There you go. Thanks, guys. Appreciate it.
Thank you.
Thank you. Bye-bye.